All right, good day, everybody. Good morning in the US and good afternoon slash evening for the rest of the universe. Can anybody hear me? Thanks for joining me. Hear me? Thanks for joining me, guys, on a Christmas week. All right, thanks. Like always, I encourage questions and whatever else is on your mind. This is definitely a session that is open-ended. I notice there's only 14, 15 of us here, so there's obviously plenty of time if you want to ask something. Um, the whole point of this was I thought that we could just look ahead to 2015, kind of maybe take 5 minutes to look at where we are in the world and how things are developing, um, and then see if we can use and extrapolate any of that information in towards next year and basically take some inventory of what we're looking at. And we'll look at the metals, we'll look at the currency majors, we'll talk a little bit about G and obviously the equity markets and where we're going there. All right. So like always, please fire away if there's anything on your mind. And Merry Christmas, everybody. Okay. So like in all of our trade plans, I hope everybody's been doing okay in the market lately. I mean, I think there's been, I don't think the currency market's been a ball of fire by any stretch of the imagination. But if you were prepared to trade some S&Ps and some things, you probably did fine. But the currency side's been pretty tight. And I think a lot of that is just because the interest rate announcement was priced into the market, and we haven't really seen many surprises. I think the only real currency surprise we saw were the Norwegians holding rates, and I think everybody expected them to cut. But outside of that, I don't believe we've actually seen anything surprising or anything new in the market. And there's no economic data that's trending anywhere. If you follow the European stuff, we'll get two or three fantastic, and then we'll get or not. And this has sort of been the cycle now for years, literally. So just do the best we can with the information we have. All right, so where are we in the life cycle of things? The tricky, typically, and you guys have seen me do this before, if this is, this is my basic fundamental outlook or evaluation for things. Okay, and I'm probably condensing, a year's worth of macroeconomics into a 10-minute period here, but here we go. Figure out how many of these we need. So we'll go US, UK, Europe. I'm not going to include the yen in this just because they're at zero basically forever. All right. And we'll put Aussie/Asia in here. All right. The Australians and Kiwis we'll do this. Well, I know they're different central banks, but I tend to group them together. And if the correlation's pretty tight here. All right. Now, this is my 10th year of trading, as crazy as that sounds. I was just reflecting on that the other day. It's gone by at an amazing rate. Before we only had to worry about interest rates. Okay, so we're going to call that IR, interest rates. Well, now we've got something called QE to worry about, bond purchases, not QU. That's different. Okay. Now, one thing to understand, or a few things to understand, is that the currency market particularly always follows yield. All right, always follows yield, and obviously there's a debt component. I mean, South Africa's got a ton of yield, but yeah, the debt to income is not so great, and it's a toilet flush. All right, so there's a few other things, but we're talking about the major currencies of the world here. All right, so while currency flows follow yield, it's more the anticipation of the yield that's going to drive where the money goes to, not necessarily the actual material fact of having increased yield, if that makes sense. In other words, the dollar strength has occurred because of the anticipation of an interest rate hike. The dollar doesn't strengthen because of the interest rate hike. All right, that is a categoric difference. All right, so in the US, although it's going to be slower than pond water, the US is raising rates. Okay, and flat on QE. The UK is flat on rates with, in my mind, the possibility next year of entertaining raising rates. That's significant. So we're flat, but you'll be surprised how the cycle of these things works, and I'll explain in a minute. Okay, QE, yeah, still printing money. Europe, definitely still printing money and no sign of a rate hike. Okay, the Australians, flat here, but there's noise of them cutting. There's noise of them cutting in Q1. I don't, we'll do this. We'll say flat on rate movement, but with a question about cutting. I don't think it's gonna. They've had incredible employment data over the last 2 months. I don't know if you noticed that. I mean, last month's non-farm payroll for them, or rather employment data, they blew it out the box. I mean, like 70,000 jobs created when they expected like 10. Okay, unemployment dropping. So although pundits are talking about an interest rate cut here, I think it's. I don't see it right now. They're in the middle. They're in the heart of summer. The Aussies are down there playing cricket. They're happy. I don't see them cutting rates, but there's talk of it. By the way, the Miss Universe thing. Yes, Columbia, you're the Miss Universe. Oh no, my bad. Huh. Sorry. So sorry. Right, so let's look at this in terms of the cycle that I like to look at. Right now, there was an old adage that used to go around that when the US got a cold, the rest of the world would get flu. Right? And it's actually kind of true still. Although it's a global economy, the US is still the tail that wags the dog. All right, so if this is the US here, okay, the interest rate cycle looks like this. US will raise first, then the UK, typically then Europe recovers, then Asia. I keep saying Asia, but I'm gonna call it the Aussie for this discussion. And because Australia is basically China, the China play. I'm not considering the yen in this equation just because the yen is, we can assume that the yen interest rates are going to be zero or near zero for the next 5 years. They are probably not going to move. Interest rate differential is probably going to be widening and contracting via these other currencies rather than the yen itself. In this equation, Kevin, I'm incorporating the Swissy with the euro, essentially. If anything, they'll be shorter for longer. Well, we just expect the Japanese to print money. It's how much are they printing money. We'll come to the yen, and I mean, I'm actually think the yen's going to appreciate. I think it's going to pop up a little bit into the mid 120s, late 120s, and then drop to sort of 110, 107. But I think it's going to be more because of a repatriation idea, not necessarily because of yen fundamentals. Yeah, so I consider that more of a constant and a less fluid situation. I feel like the appreciation of any yen is more a product of the stock market or the cross currency that it's trading relative to. The quote currency in this case. All right. Now that's, Gino, that's probably an oversimplification in many respects, but I don't think we need to make it more complicated than that. And there's also the technical look at it's also fairly important there as well, which we'll certainly get to. All right, now, so let's go back to our little cycle here. So the US has got, let's say they're going to raise rates in 2016. Guys, how many of you listened to this last rate statement? Often the news is not an announcement, it's in the statement and what Grandma Yellen has to say about why she's raising it. It was the most dovish rate hike I've ever heard. It was, we are raising rates, but the economy is rubbish. And what? What, Graham? Yes. Rates are going up, but the economy is rubbish. So, it's this, in my mind, this last rate hike was a rate increase to save face more than it was because the US economy is hot. Okay, but anyway, I mean, everybody's spending money here like a bunch of drunk sailors over Christmas. So, what do I know? But anyway, I've seen this before. So my point being is this, okay? If, let's say that this is where we are now let's say that the US raises rates 3 times in the next 12 months. Okay, it's likely that the UK will raise rates once. Or maybe twice. I'll put a little line there. Okay, and then by the end of the year, the EU will probably be talking about slowing down QE. All right, nothing about interest rates here. These guys might even be talking about cutting for the next little bit. But this is sort of how the cycle goes. Okay, so if we are at rate hike 1 here, and let's say June or March, April, May, we get sort of a second one. Okay, the UK will be talking about getting one here. So my point being is this, is that the anticipation of these guys maybe possibly raising interest rates, justifiably or not, all right, the anticipation of this will drive the pound. So in other words, we've had this anticipatory phase, if there is such a word, on the US dollar, but we haven't enjoyed that same phase in the UK. All right, so I'm setting this up here. Now, here's the tricky thing. I don't think that the powers that be in the world are particularly enthusiastic about a 70 cents euro pound situation. I think that they feel that is stifling UK exports to the Eurozone. All right. So this is certainly something we need to watch because that's going to be a problem that they have to monitor. All right. Now, so if I'm expecting this to hold above there, we're going to have periods of pound strength and periods of euro relative strength. However, I feel like the euro is going to be largely rangy, but very volatile. as they control this number, if that makes sense. So in other words, if I'm to develop a bias, all right, the US, for this is all for 2016, the US dollar is going to be moderately strong because you are raising rates, but I say moderately strong because they've already had this period of anticipating rate hikes. Okay? Remember the sort of mechanic, like when it's actually materially happening, it's mostly already priced in. All right. So then the UK, I'm expecting this to be bullish, kind of Q2. I think we're still early, but Q2 time. Europe. I'm going to put volatile range. We'll just make that our little sign. Okay. Aussie/China, little laggy, but this will be more of a Q3 situation here. So we're going to put rangy Q3 up. I know I'm busy writing in hieroglyphics here, but work with me. Okay. Now, why would I think that euro, if my little interest rate cycle here holds true, wouldn't the euro appreciate relative to the Aussie? I don't think so, because I think that people will realize that Australia's still got very good yield and it's stable yield. So I actually think that this side of the cycle is going to break down. Fair enough? Okay. Right. Now, let's keep all that in mind. Any questions so far? I know this is just the way that I kind of think about fundamentals. And you're going to remember, guys, that this is a huge cycle. Like, this stuff takes years. Years. You're talking about macroeconomics that take years and years and years to cycle around. There's seasonality that affects this. There's sort of interim things that happen, but ultimately this is the general path. And I know for a lot of you, the fundamentals aren't that interesting or are not that important to your trading. Folks, if I can impart one piece of information on you, I don't care if you're trading off a 1-minute chart. Having your fundamentals at least somewhat in the back of your mind will invoke some confidence in your trading, make your trading much more interesting, and give you a more sound understanding of what you're doing in the world and why you're buying and selling different stuff. The euro is appreciating right now for several reasons. One, it's bouncing off a massive monthly trend line, which I'll show you. And two, there's serious repatriation going on because it became a funding currency. And with equity markets getting offset around the world, you're getting a lot of the repatriation flows and you're getting euro strength. That's when you see stock market down, you see euro up these days. And in fact, when you see the euro starting to rise, you should start to look at things like the stock market dropping. If it makes sense in the different areas. Okay, so we'll certainly look at that, Kevin. I do not expect euro to rally. I do not expect euro to rally off its face here in the next month and a half. No. I'll show you what I had in mind for the euro. I think if euro is going to make a sustained run, it's probably going to be closer to the end of sort of July, August, I think. But here's on the short term. I expected. I'm gonna look at euro, but I'd like to look at pound first. Then we'll cycle back to Aussie and euro, etc. Here's the euro. There's just no surprise that it's bouncing here. Okay, it's also this stuff, isn't it? Trading technicals are not particularly difficult, to be honest with you. Um, Edward's telling me that he cannot see the chat of everybody else. Um, I'm not sure why, Ed, to be honest with you. I'll just repeat there's not a ton of chat. I'll just repeat everything that's said. So the question is, do you expect the Euro USD to have a rally at the end of 2015 or 2016 before heading down long term following the central bank's policy of divergent fundamentals? I actually don't think the Euro is going to get crushed, honestly. I actually think that the Euro will sort of bottom out here. Maybe a trip to 97, but so you're talking about a serious currency here, folks. Euro is not child's play. Yeah, on the short term, I was expecting sort of something like this. I will circle back to the Euro and give you the long term perspective, but on the short term, I was kind of looking for this. Something along these lines where it makes a little lower high here towards 109.50, drops back towards about 106.70, and then pushes up towards 111 before dropping again and trying to, form this base. You got to remember that when you start to get basing out of currencies or any instrument for this matter, you're going to go bearish, neutral for a long time. And then often you'll get one more, huh? Oh, okay. Then you'll start a bullish phase. Okay. And this can take 3 years. This can take 2 years. And this is 3 years. Literally, this is how long it takes. Sometimes longer. I argue that we are kind of still in this phase. I argue that we are sort of in here. So you're going to see kind of violent swings within the context of this 105 to 112 range. But it doesn't necessarily mean that the euro is making a move. It's just in this volatile neutral phase, which is typical to what you see at the end of a trend. I do, but I think it's more something like this. The least interesting currency to me, actually, okay, so the question is, so you don't see it back to 105 where it was before the Draghi disappointment. The thing is, euro is one of the least sort of medium-term interesting currencies I like, actually. I think we have better fish to fry. To me, the focus is S&P and pound. And then Aussie kind of a second there. This euro is going to be, okay, I will say this differently. When euro prints anything from 98 to 105, I'm buying it. Although things are rubbish in Europe, supposedly, the Europeans will get it together. They will. And I feel that in 24 months from now, we're going to be looking back at the euro around, parity, and it's going to look like a freaking bargain. So I was thinking kind of something along these lines. Range, something like this while it bases out. So my thing is that I'm done selling it. Every time we get through this 105, 106, all the way down to parity, I don't care if it breaks parity a little bit. I'm a buyer all the way through here. But I'm not looking to hold on to it. Every time it bounces up several hundred pips, I get out, let it recede back, buy it again, let it recede back, try and shuffle stops up on it. It's not something that I'm looking to take on a sustainable basis because of that fundamental divergence. Yeah, and there's, Kevin saying I wouldn't mind selling the top of the range. Yeah, I don't see any problem with that. I don't see any problem with that. Picking something between sort of 114 and 116 and having a go at it. It's pretty worth 200 pips every time at the least. It's good money, isn't it? But, as far as trying to trade euro and hold on to it and run a trend, I don't see it. I obviously could be wrong on that, but it's not. And if I am, it's one of those things I'll miss, but it doesn't tickle my fancy maybe as much as some other things. If you look at the euro pound, and I'm speculating on this when I say the 70 cents. I just don't think that, the government looks at this and goes, 70 cents. Euro pound I'm talking about. Below that, you're starting to make British exports, although it's not, an industrial nation anymore, so to speak. It's still important. Even tourism movement. So I think that this zone is going to be defended. So it's likely you're going to see these volatile sort of movements on the euro pound. And the pound is going to be prone to that volatility. So what's going to be interesting is how the dollar looks when the euro pound is at extremes. Okay, so what's extreme for the euro pound? Extreme for the euro pound in my mind is between 75 and 77 on the upside, and on the downside 68 and 70. Because if we're at 69.20 and it looks for all intents and purposes that the dollar is going to weaken, you probably want to be buying the euro dollar and not so much the pound, because it's likely that the pound will suffer, a lack of relative strength during that period. Or said differently, if we're sitting up around 76 and the dollar looks like it's going to lose strength, then the pound is your pair, because the euro pound is going to drop. You're going to get good pound relative strength and dollar weakness. Now, you got to remember that you can still buy pound independent of where the euro pound is, right? These are two mutually exclusive things. But, the quality comes into play better when you add extremes on the major correlated cross, if that makes sense. I'm getting a little bit technical on you. I sense without looking at anybody that there's a little bit of a glazed look going on. But these are pieces of the matrix that you have to keep in mind. Does this make sense? All right, so let's look at the pound. I think that you are going to start to see some relatively surprising good pound data coming out second, third month of 2016. Okay. Overall, this is a monthly pound chart. What is pound? It's essentially a range. Okay, we have kind of two ranges within the larger range. We got this sort of median term range here between 51 and 62. Call it 50 and 62. And then we got this sort of range above that. Because you can see that sometimes we stop there, other times we nudge above it. So that's what I'm calling a kind of a secondary range. And then the same thing on the bottom end. Half the time we stop there. Half the time we kind of push below it to the lower end. All right. So really, yes, pound bust above this during the housing bubble. And but it's interesting that overall the pound is pretty tethered to the dollar, right? I mean, these are major swings, I will concede, but overall, pound is pretty committed to what's happening on the dollar. Okay? And that's a product of them fundamentally chasing each other's tails. The UK and the US are not too far apart, right? Fight the same wars. For whatever reason, everybody enjoys soccer. I mean, cricket, baseball, I don't know. But for all intents and purposes, these guys follow each other around. Okay, now we are heading towards the bottom of this range. Okay, and admit this is a monthly chart, so it takes a long time for this wheel to turn. But I think fundamentally we're going to start to see some news that's going to chase this thing. It's going to base out and chase this thing back to the top of the range. Yeah, I mean, I'm making this up as I go. So. Cricket, soccer, football, pads, helmets, rugby, not rugby. Okay. So I think technically we're going to bounce off the bottom of the range, and fundamentally you're going to start to see some improvement in the UK economy. And there may not be a rate hike until much later next year, but the fundamentals will start to thaw out. Okay? So in other words, my trade idea here was every time we get into the late to mid 40s, I'm a buyer looking for the mid 60s. Something like this. Buy. It's going to take a little while. And I know this isn't I think it's also worth mentioning that, this is the best. I don't think that 2016 is going to be a brilliant currency year. The way the fundamentals look, I think that a 1200 to 1500 pip move is going to be a good move. I don't think that we're going to see those watershed things where they go thousands of pips. It just doesn't look fundamentally set up for that. So, if you can grab something that goes up 1500 pips and trade multiple times within the context of that, you're going to make your money because you're artificially making it a bigger move than it is by trading more within the context of that. But, and just going back to what I was saying on the euro pound, if you got EG at like 76 and you got pound at say 46, I don't know, and that, these are all, I'm doing this all on the bigger scale here, right? This is an overall look at next year. If you got this scenario going on, I'm buying pound. Does that make sense? Because here you got euro pound in extreme, you got British pound versus the dollar in extreme. And maybe this is something where you don't necessarily even trade the pound USD. I mean, maybe you trade something else that's been weak. Maybe even short the euro pound specifically. Although I don't necessarily like to trade after you've had a major support bounce, which is what 70 is. I like to just let it be then. Okay, but this is my number one trade idea for Q1, Q2 of 2016. What time frames what time frames do I trade? I trade all the time frames. I am a hybrid technical fundamental guy. So I will only trade in the direction of my fundamental bias, but I of course will try to trade it on a longer term time frame as well as a shorter term time frame and commingle those things. That is as convoluted an answer as I've ever given a human. But does that make sense? My thing is I have a fundamental bias, and when it reaches a zone that I like, I'll just buy it multiple times within that zone, and I'll try to use the shorter term time frames to facilitate that transaction. But ultimately, it's a macro fundamental bias, and it's a longer term technical bias. You've got to remember I've done several lessons on market fractals, and you've got to remember the definition of a fractal in the market, all right? It's a self-similar building block of the larger whole. So the way it was explained to me once is that the shorter term time frame is like if you were looking at a painting and the painting might be 3 foot by 4 foot, but if you were shown 1 pixel of that painting, you could see all the detail of that painting in that 1 pixel. It's a self-similar building block of the larger whole. So that's why I like to take it from the large and then narrow it down. All right, I've got 9 minutes, so I'm going to bomb through my trade recommendations here. Okay, let's talk Aussie. I'm mostly bullish on Aussie, but I do not hold anything Aussie. I'm only going to start holding Aussie stuff towards the end of 2016. Because of that fundamental, I'm using my hands to talk, which is a little odd on a computer, but because of that interest rate cycle that we talked about right up front of the show here. All right, so, the Aussie, anytime we get down into the late 60s, I'm buying it. I'm actually starting to buy it through the 70s, like 70. I think I have orders at 70, 80, 70, 40, all the way through 69 and 68. And I'm trying to take this back out towards 80 cents. Okay? And that's largely because of the support, my fundamental bias, the development of yield, the fact that I think China will start to correct itself. And technically that is the top of this range. And that monthly 21 EMA, and if I take a fib of the swing drop, prospectively from 67.50, 80 cents is the 50% of that drop. So I projected the fib to where I believe it's going to bounce relative to the support, and the 50% of that swing drop is right around 80 cents. It's the psych level, and it's the top of this range. So I'm looking for it to do sort of something like this. Cruise back up here, and that's a 1200 pip move. Yeah, I mean, all market, yeah, so good book, Resource Trading is the Fractal Mindset. I haven't read that book, but, Mandelbrot maps are effectively what fractals are. Thanks, Alex. Yeah, the Alex says 15-minute follows fundamentals half of the time at best. Yeah, it does. But here's the thing is that I only like to trade in the direction of my fundamental bias. So in other words, I'm only buying pound. I am only buying euro. I am only buying Aussie. I am only selling the S&P. I am only buying silver. So I am only selling the yen, or the USD yen rather. So in other words, I ignore 50% of the downside price action on those things. I've had I've had sort of one goes through these trading developments in one's life. And like I said to you, this is my 10th year of trading. It's astonishing to me. I mean, it's taken 10 years. Anyway, anything more practical for a trader to time trades? You see, okay, so let me answer this very quickly. Okay, and if FX Street's okay with it, maybe I can go 5 minutes over. By the way, S&Ps, I'm still believing in a move down to this sort of 1850, more like 1760 range. I wish we had broken last week. I really wish we had broken 1985, but I'm still a seller at 2040, still a seller at 2080, and even if it nudges higher, I'm shorting for that move. And then I believe, shorting for this move prospectively, and if it goes a little higher, I don't care. Something down to here, and then I think we'll just see a massive range for a long time. And, people just stock picking will make money in here, but those actually looking for the move won't. But pound is my, trade of 2016. So is the short. And playing that euro range effectively and picking up the Aussie towards the end of next year to hold. I think there's going to be interim buying opportunities, but the buy and hold, I believe, is towards the end of the year. And I want to finish up this question adequately. Gold's just the one that gets the publicity. Makes sense to buy silver, but what about gold? I think gold's just the one that gets the general public involved. All right, any view on oil? I just think oil's going to be on its face for a long time. Let me answer the question about any other more practical means to timing trades. I'm gonna give you a 1-minute oil answer, and then we're gonna answer that. See, here's the thing with oil. Okay, you got the fracking guys and you got the drillers. The fracking guys turn on supply in 24 hours. So the minute the price rises or supply dwindles, the fracking guys turn on and go, great, let's produce a bunch of oil. And they do. And it costs them about $60 a barrel to do so. Okay? And as fast as the price rises, they make their money and they can turn off supply in literally 24 hours. They just send everybody home and say, we're done. Okay? The drillers go, okay, well, let's get moving now. Price is rising, so let's increase production. And it takes them 60 to 90 days to get that done. Okay? So you have the fracking guys that they increase production and cut production in 24 hours. The drillers take like 90 days to get this done. So supply here goes, supply increase on the frackers. All right. Price drops a little bit. Okay, and then all of a sudden, the drillers come online, and they go supply increase, severe price drop. The frackers are the guys that basically use water to, and I'm not educated on this, to literally squeeze oil out of the earth. It's not particularly great for the ecology. So how oil typically worked is that it was all drillers effectively, and the supply and demand could be closely watched and closely monitored and closely turned on and off because he knew lag times and global production. Well, now we've got the situation where the supply is being bolstered after the supply glut's already in place. And this is a dynamic we haven't seen for years. I mean, ever, basically. So, oil, oil I just think is going to be lousy for a long time. Oil, I think we're going to see sort of something like this. Where you dip down into the late 20s, you recover to 45 to 50, and you live between 35 and 50 for 18 months. Yeah. I think anything into the late 20s is an overshoot, though. But the interesting thing to look at, is more, I was talking to a guy, I know I've got to get off here in a minute. I was talking to a guy on Thursday who is a ship's captain that does the support for a lot of the drillers in the Gulf of Mexico. And he was saying how a lot of the platforms are being closed down. And a lot of how the smaller operations are going out of business. Because it takes them $55 a barrel to make money pulling oil out of the ground. You got to figure what goes into that. It's no joke. And my question is, who's the private equity that's going to be buying all this stuff up at a fire sale? I mean, if you want to invest in oil, that's worth investigating and maybe getting in on some of that, as a long-term oil play. Is the vulture capital buying oil assets at bargain prices? Guys, I'm kind of out of time here. The question was, is there a better way to buy stuff than, shorter time frames? A lot of that's going to depend on your psychology as a trader. Over 10 years, I like the nitty gritty of buying on very short-term time frames and looking at things. But to be perfectly honest with you, I get a little jaded with that. I am much happier buying stuff, holding a fundamental bias, and picking it up at different levels and trading. And it can get very scary at sometimes. I thought this S&P was going to, break my will to live. But try it. Try taking a broader perspective. You might like it. Folks, have a very Merry Christmas. I can always be reached at Forex David on the twit, Forex David on the twit. Thank you to FX Street. I think we've been doing this now, webinars with, I think I've been a speaker here for 5-6 years, and it's, everybody's been super, and I absolutely appreciate all the support, and I hope to see everybody in the new year. So thank you, everybody, and we'll talk to you soon.